everybody. Welcome to the TraderMerlin Show. It is your Thursday edition, getting ever so close to that weekend. Hope you had a great trading session. Now the bulls all of a sudden get their day in the sun. We've had some bear days, some, sleeping, non-event days, and all of a sudden a bullish day today. We'll talk about market behavior a little bit later on. For right now, though, I'm going to get to our topic at hand. And hello, everybody, and congratulations, John, for beating out Les for first place today. I see you guys are all competing to beat Les to the room. But anyway, good to have you all with us today. Let's get rock and rolling. Here's our topic du jour. Our topic du jour is bonds, central banks, and interest rates. Joining me from the East Coast, I'm assuming we got the talented Mr. Bill Addiss joining us. Bill, how you doing?
I'm doing great, Merlin, and I don't know about talented, but yes, I am back on the East Coast, and from beautiful Washington, D.C., the swamp.
Oh, you are talented. It's funny because I can never stop thinking of your story of you running down the street to the bond auctions. That's talent. That's talent. So we'll keep it there.
In a former life.
Absolutely, in a former life. Let's briefly go into what happened with Jerome Powell yesterday. I did a show yesterday, kind of talking high level about it. To me, it was a blah, blah, blah kind of moment. I didn't see anything that was absolutely noteworthy. What were your takeaways from yesterday's performance, I should say?
Yeah, and performance is a good word for it. In terms of economic information, it was a big yawn fest. The Fed did acknowledge that their targets for GDP next year are coming down. Their forecasting is a bit more pessimistic. But it was a performance, but I have to give them credit, whereas it was a big yawn. I mean, there was no real quantitative news that came out. Policies are unchanged. Well, we can look back, though, and see the Fed did do a good job of managing this taper discussion, where now they can actually talk about tapering. And look what the equity markets have done in the last 2 days, even though he did finally use the dreaded word taper. Back in 2013, when they introduced the idea of taper, we got the taper tantrum.
Right. People freaked out a little bit.
And I think the Fed learned from that. And I think we can successfully look at the last 2 days of equity reaction and say they successfully navigated that hurdle of preparing the market that this adrenaline and pipeline of liquidity is going to start drying up.
We know at some point that's going to happen, right? At some point we'll see the liquidity dry up. Let me ask you this: you and I did some sessions years ago on Power Trading Radio. We also did some special videos, which are at OT Academy, which hopefully we'll get those resurfaced because they're phenomenal with regards to bonds. But you talked one thing about the transparency and how they're very clear on what their goals are, objectives. It seemed more so than they've ever been. Right. That said, what I noticed from Powell in his, not just the statement, but also the press conference afterwards, and this one really kind of got to me, is Powell kept saying, when they meet our objectives, when they meet our goals, when they meet, and they kept pressing him like, what's the unemployment goal? Oh, well, this and that and the other thing. And he never came out and said, this is our goal for unemployment. He did say for inflation, right? He said inflation, but he goes, different metrics will give you different results. And I'm sitting here going, hey, I want transparency. You guys can continue to print money ad nauseum until forever. Right. But you've given us parameters and you say, well, when we meet these goals, and it's like, do you have any clarity on what those goals might be?
Well, and actually, this tangentially goes into a conversation we were going to have about something else. But as you said, on the inflation side, I think they've been very good about setting the targets and where, whether it's transitory and what their goals are and the targets. I think they've been very, very clear on the inflation front. On the unemployment and jobs number, you're right, they are vague. But this comes down to my whole bone of contention that the way we report unemployment here in the U.S. is a fool's game. Mm-hmm. That for Powell to target the unemployment rate, as the press likes to talk about it, would be meaningless relative to what the Fed's goals are. We, generally speaking, out there in the world don't understand what the unemployment rate means. It's not a measure of how many people are unemployed. And that's a common misnomer. What we really should be talking about and looking at is the participation rate. And you never hear the Fed talking about that because, honestly, my bias is that's a much more bleak picture. And I think we've even got some slides to kind of illustrate that. If you want to go off, I didn't mean to take it off on a tangent.
No, it's great. I'm fine with that. I'm actually, I'm bringing up a table here, and maybe you can talk a little bit about it because the rate that we are presented is the U3 rate, right? And I brought a table up here, guys, so you can see there's all these different classifications. It's kind of funny because I think as Americans, I'm going to say this about myself. The viewers, you guys can maybe feel the same way or not. But when I hear the term unemployment rate, it's like, okay, that's what the unemployment rate is. But it's like, no, it's like saying, here's a Coke. Well, I've got Diet Coke, I've got caffeine-free Coke, I got Coke Zero, Coke Plus. It's like I got 15 different products. right here, there's 6 different variations of the unemployment numbers. U3 is what we're quoted, which is the rosier, happy one. May as well quote the U1, which right now says we got 2.7 unemployment. Okay, right. U3 says 5.2. Most people, including the ambassador of opportunity, John O'Donnell, are out there going 8.8. That even seems low, and that's the U6.
Yep. And I'm going to illustrate the point even more. You're perfectly on. And you and John, I know, have been talking about this. But as you said, the unemployment rate that we often quote and the press likes to talk about is this U3 number. And you've got the slide up there showing what's happened since October of last year. And you can see, the unemployment rate, as this is being quoted, dropped from 7.8% when the pandemic was at its height, now down to 5.2%. That visually and even numerically seems to be creating a pretty rosy picture. Mm-hmm. That in spite of everything, in spite of the Delta variant, we're down to a 5.2 unemployment rate. Well, that's not what this is saying at all. All right, the U3 number comes from the Social Security rolls. All that we're measuring here is the universe of people that have become unemployed in the last year. That's a very small microcosm of the entire universe. I mean, for people to say this is the unemployment rate, it's just not true. Mm-hmm. For you to be included in this number, you had to have lost your job in the last year and still be looking for a job. Mm-hmm. And of the overall population, that's a sliver of the overall population. And in the next slide, I tried to give you a kind of a better visualization of this. So let's say we had a world where we had 151 million people were working. All right, okay. They were employed in the workplace.
So 46% of the population, 45% of the population. Yeah,
and then we had 7.7 of them were unemployed in the last year. So they're on the Social Security payroll, the Social Security logs. So that means we basically put the unemployed and the employed together. We've got a population we're looking at of 159.1 million people out there that we're measuring.
Right.
And of them, 7.7 are unemployed. So we've got a 4.8% unemployment rate. I hope that makes sense.
Yep.
What is totally excluded from this conversation, though, is the 94 million people who are out of the labor force. Meaning these are the people who lost their jobs back in 2008 and haven't been able to get a job since. For all intents and purposes, they have ceased to exist from an economic point of view here. Well, that's not fair. I mean, they're out there. They are unemployed. Why are we not counting and measuring them? I hope this makes sense. So what I'm saying is if you've been unemployed more than a year, you're off the Social Security benefits rosters. You're not even included in the universe of people we're counting as employed or unemployed. You just disappeared. And that's a huge universe.
Right.
The next chart we've talked about is a better number that we should be looking at.
Oh, boy.
And this is, look at this chart. That's the participation rate. Now, this looks at the unemployment situation from a much broader scale. And by the way, I would go back to the unemployment number, the U3. I'm firmly convinced the reason we quote the unemployment situation that way is because it's very politically expedient. Mm-hmm. Right? It'll always show a lower unemployment number than the actual situation. So I'm not saying conspiratory, but I do think it presents a rosier picture. And that's why the press likes to look at the unemployment number.
Yeah, and this one really does tell the story. The little pie chart here, you've got 3 slices: employed, unemployed, then out of the labor force, meaning they're not even looking. Or maybe they are looking, but they're not in it right now. That's 94 million.
Social Security benefits, they're not recognized by the Social Security system.
Right. So basically your unemployment number, you're taking that 7.7 unemployed, dividing it by the 151 total, so 159.1, right. And that gets you 4.8. And that sounds so great, but it's like, well, wait a minute. There's 330 million people in the U.S. and 94 million are out of work. It's like, hold on a second. Right. I'm working my ass off every day. What are these people doing?
Exactly. So it's greatly underreporting the actual unemployment number.
So what do you, and obviously this is nothing to do with us, you or me or our viewers. This is just a political theater number used. I mean, is there a solution for this? If we start throwing around that U6 rate, does it make people cringe a little more to know how high that potential unemployment number is?
It does. Or if people look at this participation rate that we're going to, what this chart is showing you, look how dramatic that drop was in the labor force. We went from 63% down to 60%.
Yeah.
And we haven't made back half those jobs. Half the people who lost their job in the pandemic have not regained employment yet.
Well,
That's a far different picture than saying our unemployment rate is at 5.2%.
I agree. And you're right. And you especially look at that labor participation rate and how it had such a sharp drop. That makes sense, right? Obviously, going to a pandemic, you're going to have a lot of that going on. But,
Sure.
Now we still are quasi-incentivizing people to stay on unemployment. Of course, I personally think that has to go away, and you should almost remove unemployment benefits now, because there are jobs available for just about everybody. There's so many jobs out there, but people just don't want to take them. It's like, oh, I'm not taking a job that pays minimum wage. You kidding me? Well, I don't know. Get back on the horse. But John O'Donnell, yeah, in a real world, I don't know. My dad taught me to work hard and keep working. No matter what happens. Some people are just like, oh, a free handout, great. I'll just take that and milk it for all it's worth. On this labor participation rate, John O'Donnell and I were looking at this back in 2011 and 12, watching how sharply it was sliding. Clearly since the 2000. This has been just a very sharp, very steady decline. If I look at where it's at today, which is sub 62, if I were to take a moving average, it would be trending down, and we'd still would be below that one. What do you think it's going to take to get labor participation up? I mean, it just looks like the trend is to not participate and to, I don't know, what these people are doing.
Well, personally, I share your sentiment. I think the fact that, we have been rather generous on benefits for extended period of times is keeping people out of the workplace. So I do think comes the end of September, when those benefits are lost on a lot of the states, it'll be interesting to see what this number does. But I also think, and this gets me into my big fear, I think bottom line, firms are going, and we're starting to see it, are going to have to start paying up for entry-level jobs. You saw the announcement from Amazon, what they're going to be paying for starting even small businesses. So, what we're looking at is the prospect of wage inflation. We got to, I don't want to say bribe, but we have to pay people a higher wage to get them to come back to the work. And I have to say, my big fear, and I did an XLT class yesterday when I said the word of the day, is stagflation.
Stagflation, yep.
I really, really worry about stagflation, and wage pressure can be a big part of that stagflation picture.
Les asked a good question, and I don't know all the specific details. This one you might know better. Now he says, does that non-participation rate, does that include children under 18 and in school?
No, and the specifics is it's ages 16 to 65, so it's the entire U.S. demographic population, 16 to 65, excluding military and excluding people in prisons.
All right.
How's that for trivia?
Hey, you know it better than I do. Good. How has automation and AI played into the participation rates? Well, clearly automation is one of those forces that's going to be displacing workers and contributing to unemployment. And it may just remove people's jobs and they become part of that yellow pie, which is, I'm not even going to look, or they are actively looking for jobs out there. So I think there's a lot of different ways to look at how AI impacts it. But before we say AI is bad or these types of technology changes are bad, I just want to go back to when I got started with trading back in 1998. There was all this talk that this technology and trading was going to replace these types of jobs. And then you had assembly lines with robots replacing jobs. Bottom line is we're going to always have this. There will always be some technology that replaces something else. It's our job and our responsibility, me personally, to constantly be innovating myself and saying, okay, if I see the writing on the wall for what I'm doing and that's a dying industry, then I'm going to have to immediately start to change paths here and move. But I don't know if it's directly factored into the unemployment rate, but certainly I think it does have a big factor in the unemployment numbers there. There you go.
I would wholeheartedly agree with everything you just said. But when, since the assembly line first started, when has the growing technology not been a part of the discussion? So that's nothing new.
Yeah, always technology is ever present. Man, we got some good questions coming in here. Let's see. How is it on misplanned? John Donato says, any thoughts on how the moratorium on evictions may be exacerbating the desire to return to work? Yeah, look, if you know you're not going to lose your place, they can't get rid of you. Milk it for all you have. What I feel bad for are landlords. Like, who's helping out the landlords here?
Yes. No, and you're absolutely right. The landlords are the ones who are suffering here.
Yeah. Ellen, it says, and Grant, this one's back to me. It says, why do so many people think that those of us that are not employed are not wanting to work? I think that there's generally there is definitely a perception of that. I know that a lot of people that are wanting to work, but I have one friend in particular that he could have accepted many jobs, but I don't want to mention his name. I would say that this individual is very stubborn and he's demanding a certain level of pay. So in many senses we could get jobs, but it might have to be a step down. And right now, I think that you seem like you should be getting more money because the competition doesn't seem to be there. It seems like a lot of people aren't applying for these jobs, so now employers are having to pay more, as you mentioned with Amazon.
Yep. No, and if you look at this chart on the labor participation rate, the unfortunate part is when you go back to 2010 and you see that, we had that drop off below 66% and never been above since. The point is so many people did lose their jobs back in the Great Recession.
Yeah.
And for one reason or another have not been able to or willing or able to get back into the workplace.
Yeah.
This is a pretty major demographic shift. 2% of the population just never made it back into the workforce.
Absolutely. And we'll hopefully we'll get back up there. There's opportunity out there, and hopefully we can get back to full employment. And I'm hoping we do, specifically because I want to get the Fed out of the picture. And I know that you have some relations with the Fed, but my opinion of the Fed's become a little more jaded over the past couple of months. But we'll see how it is. But get them out of the picture. Stop letting them pump the economy, and hopefully we can get back to a normal free freer market economy.
I look forward to that date, and I don't think I'll ever see it.
Yeah, I like your optimism.
No, I just mean the intervention is here to stay.
Of course, yeah. I mean, you've got a drug addict and they're hooked. So,
right.
Let's talk about government. So you and I were talking before the show on how Congress has been kind of, in some senses, inept at doing their jobs. What? Yes. And there's some people going to be footing the bill for that ineptitude. So walk us through what's going on with regards to Congress and them not completing their tasks.
Yeah, no, and there's a couple things going on, and it gets frustrating because we've got a big sense of deja vu here. The first issue is out of Washington is the debt ceiling.
Yep.
We've got the debt ceiling, as you might remember, was Congress's way of trying to curtail their own activity, that they would falsely put a limit every year as to how much we could borrow. Invariably, they wouldn't curtail their spending, so we'd hit that limit. And then we'd have to either shut down the government or extend the debt ceiling, and it just added a stress to the market we don't need. And this has only been going on for the last 20 years, so this is relatively new. But when the pandemic hit, Congress wisely, I think, recognized that they were going to be spending a lot of money, the various stimulus packages, so they suspended the debt ceiling for 19 months. Well, that ended in July. At the end of July, the debt ceiling suspension ended. The debt ceiling kicked in, and surprise, surprise, we're over the debt ceiling.
Yep.
Now, what that means is, logistically, is the government can't borrow any more money. Now, we can finance existing debt, meaning, if we have a T-bill that matures this week for $26 billion worth, we can issue another $26 billion to replace that, right? That would not be increasing the ceiling. We would just be rolling over the existing debt that's coming due. So since July, that's what we've been doing. The Treasury Secretary Yellen on August 2nd also said that in an effort to not have to shut down the government, that we were going to take extraordinary measures. And basically the talking heads on TV jokingly said, this is the government looking for change in the sofa. To pay our bills, we're scrounging around looking for odd monies here and there. And that's exactly what they're doing. Unfortunately, when you look at the details of what extraordinary measures are, I personally think it's reprehensible. Yeah. Because with Congress's inability to deal with what they need to, the Treasury Department now having to take extraordinary measures, that means the government isn't making the contributions they're supposed to do to the Civil Service Retirement Fund, or the Civil Service Disability Fund, or the Postal Service Retirement and Health Benefits Fund. In other words, they're putting it on the back of the retirees to cover the deficits that they've caused. I think it's reprehensible. And the other big one I forgot is they're not making any investments into the Government Securities Investment Fund. That's the biggie.
Talk to me.
I just find it reprehensible, honestly. I'm getting more jaded, I guess, myself. With Congress's inability to do the job we pay them to do, they're now putting the burden on the retirees.
Yeah, which is a scary proposition, and that can't end well. Walk me through a little bit. So you mentioned the government and securities investment. What is that program, and why do you think it's so important?
Well, that actually is part of the funding vehicle for money that goes into Social Securities. In other words, they don't always make direct payments in there. That's kind of a general funding account, if you will. And there are many other things that slave off of that, including some, not all, of the Social Security payments.
Okay. Margaret says, give us your opinion of Yellen, Bill. You're gonna so you see, here's the problem, guys. He can't because he wants to be Treasury Secretary. I know, Bill. You want to get up to that high position.
I admire Janet Yellen. I'm not gonna deny. She grew up as a banker in San Francisco, was president of the San Francisco Fed, then got over, to just being a board of governor member for the Fed, now the Treasury. I mean, let's face it. There's not anybody out there who has the depth of experience that Janet Yellen has.
Yeah. Look, I'm definitely the first to throw some shade at some of these guys for what they're doing. Yesterday, I think I told you, Bill, and the viewers remember, I called Jerome Powell kind of the donkey of the day. But obviously he has a near impossible task. I mean, I guess it's not impossible. You just keep printing money, and it'll eventually fix itself somehow. But I certainly wouldn't want this position. So my opinion of Janet Yellen, I don't think bad of her. I think she did a decent job. I mean, it's tough. I wouldn't want to do it. I don't. Me personally, it's not the individual at the helm. So, for example, Powell or Yellen or Bernanke or Greenspan or Volcker. It's, to me, the establishment, the institution, and their overall manipulating and finagling that bothers me. But there's nothing we're going to do to change that. It is part of our system right now.
No, and I 100% agree with you on the individual side. I also don't want to be misinterpreted. I mean, please understand, I do feel that the actions of the Fed, the amount of liquidity and stimulus they are providing is just gotten to the point of absurdity. I mean, even when the Fed talks about cutting back and starting to taper, the number that's coming back in the market is that they're going to curtail so slightly that the amount they'll do in the next year is greater than the QE2 initiative they did back in 2010. Mm-hmm. So, the Fed still got pumping the engine. They're cutting back on the gas, but they haven't stopped the gas.
Right.
And we had the conversation a month ago. You look at the amount of cash in M1 in our marketplace, I'm really worried about stagflation. I'm really worried that we are creating bubbles. And I hate to use that term, but when I look at the equity market for the last 2 days, somebody somehow is going to have to explain that to me.
Yeah. I was just trying to bring up the chart here for it. Sorry, my computer glitched. I was trying to bring up the TradingView platform. But yes, at some point, I think it will come crashing down. Let me ask you this one, because I picked this up from the press conference afterwards. Obviously, there were some decent questions. A few of them were dealing specifically with the insider trading thing, which is a different discussion. But Powell said, he mentioned tapering, and I thought that if Evergrande didn't surface this week, that Powell may actually make an announcement they would start tapering slowly to the tune of maybe $5 billion a month on treasuries and mortgage-backed securities, and then we would slowly see that unwinding, that purchasing slow down. He said, no, not going to happen, probably start next year. And then he also said, we hope to conclude our tapering by mid-next year. And it's weird, we have this finish line of, let's call it July 31st. Right? I'm throwing that number out there because he said mid-next year. That's the exact halfway point. You got, June 31st. You have this finish line, but we haven't started tapering yet. So it seems to me like the longer we wait, the more dramatic those cuts are going to have to be to meet that deadline. Think it's realistic to hit June 31st?
No, and I don't, honestly. No, but just remember, tapering just means they're not putting the new money in.
Right.
The real question is their balance sheet, as continues to grow as they're reinvesting all this money. When they stopped printing under QE, the balance sheet was at about 7.2 trillion. We're up to 8 trillion. The balance sheet is continuing to grow. So tapering just means they're not going to be growing. The real question is, when are they going to start really unwinding the $8 trillion portfolio they've got? Or let's be honest, if they ever will.
Right. Yeah, I'm in that camp as well, if they ever will. On a different topic, let's talk about unsecured debt and corporate debt, and talk about China's issue with Evergrande. I'd like to get your 2 cents on that. I'm hearing so many different numbers from different people. They made their payment yesterday, which I guess everyone's like, ooh, wow, they made their payment. Markets rally. But to me, it seems like they're clearly not out of the woods yet, and it looks shadier and shadier and shadier every day the news comes out. Now, tell us what your thoughts are on Evergrande, and then what you think the impact to not only China's market, but what that ripple effect might be to the global community and us specifically in the U.S.
Well, great question, Marlon, by the way. That's why I enjoy talking to you. Great question. This is basically akin to our mortgage crisis back in 2008, right? Because Evergreen, as you know, is entirely funding the mortgage industry, or a big part of the mortgage industry over there. So the credit deterioration we saw in mortgages here in the U.S. is basically what's being replicated on a corporate level over at Evergreen. the bonds are taking a hit. The bonds are trading at 26 cents on the dollar. So they're looking at the bondholders are expecting liquidation or something. The obvious question, though, is how dramatic does China want to get involved?
Yeah.
This is not a capitalist structure like we're used to. So,
well, and that's the funny part is like, yeah, they're not a capitalist structure. And here we have to, we had to bail out Lehman Brothers and these other banks because it was a systemic failure. This is clearly a systemic failure for China. But, now all of a sudden they start to look more capitalistic if they do bail them out. And, China, on one hand, my opinion is they cannot let this happen. They can't let it happen because in China, for those who don't know, Chinese citizens don't buy bonds. We are told to buy bonds. That's our investment vehicle and equities. Chinese citizens are predominantly buying in real estate, which I would argue is probably a better investment than bonds, but that's a different story. And you have this bubble type market where people are literally bidding on unfinished properties that are going to be done in 5 years and putting all this money into it. So if you can see how thinly that gets spread out, where if I'm a Chinese citizen and I put all my savings into 2 or 3 properties that haven't even been built yet, how is Evergrande going to settle that debt? They're going to have to start selling properties that they haven't even finished. So this gets ugly.
No, it's the mortgage crisis wrapped up in a corporate environment. But for exactly the reasons you said, I think China is going to have to step in. The other thing I would just point out is when people talk about it as a Lehman event, being a former Lehman officer, I take offense to that. No, but the Lehman event, one of the things about the Lehman event was how quickly it happened, right?
Yes.
Within a 2-day period, we went from rumors in the market to liquid, to filing for bankruptcy. The speed by which the deterioration happened. People have to remember this is not new on our radar screen.
No.
We've been talking about this, and the talking heads on TV have been talking about, and we've seen the credit deterioration of these bonds for the last 6 months. So, this was a slow, agonizing situation, unlike the Lehman, which was kind of an overnight. The other aspect is, usually when you have a crisis like this, it's not the original crisis, it's the spillover to other situations. In other words, what other banks might be exposed to this name, not the name itself going under, but is there exposure on the banking side?
Right.
Some of those type of situations. But by no means is this a Lehman event. This has been a slow, torturous situation that finally caught the eye of the press after 6 months, or the public after 6 months.
60 Minutes did a session, it might be 2 or 3 years ago now, called The Zombie Cities. Right? I mean, you're looking at
that. You're absolutely right. Thank you. You're absolutely right. I forgot that. So, people, this should not be a surprise.
Yeah, I mean, and that's the thing. And that's why we saw such a knee-jerk reaction earlier this week to the South Side, because, and I see some people saying that China wants nothing to do with it. Well, I agree with you. China probably doesn't want anything to do with it. But if they let that system implode, if Evergrande implodes, you'll have civil unrest because tens of millions, if not hundreds of millions of Chinese citizens have been buying into these properties. And it's not just Evergrande. There's a whole slew of real estate companies doing the same thing. So now all of a sudden it becomes a question of, man, our citizens are going to lose their minds. And I don't know, do you get mass rioting in the streets? Do you get people, who knows what could happen? I don't think you can let that kind of social instability happen, regardless of whether you're in a democratic, a communist society. You can't have that kind of, I guess, massive systemic failure. And Evergrande, my guess is China's going to start chopping some heads off, maybe quite literally chopping some heads off to make it an example of these guys.
And you probably saw this weekend that those type of protests have started.
Mm-hmm.
And, that's most unusual for China.
Yeah.
Since Tiananmen.
And it hasn't even really hit the fan yet. I mean,
right.
They're still a standing business, but if all of a sudden they start liquidating assets or China doesn't step in, could be real ugly. With regards to U.S., obviously we saw a 3% slide a couple days ago. We've pretty much bounced back since then. Is the China thing, from your perspective, a huge risk to the U.S.?
Well, in that they're our largest trading partner. But again, I think they're going to contain this risk. I really don't see that China will have the problems that we had relative to the mortgage side because they're going to be more aggressive in intervening. How badly it affects the market, I don't know what percentage, and I'm sorry I don't, but here in the U.S., when mortgages and the mortgage market took a hit, mortgages and banking and finance industry around housing represents 65% of our economy. So when the mortgage market here in the U.S. took a hit, that was 65% factor of our GDP. I don't know what the percentage is in China, quite frankly.
Yeah.
On the one hand, you hear stories about people being over leveraged with 2 or 3 houses, but on the other hand, you hear about wastelands where there isn't housing. So the answer is what percentage of the population of the economy is based on housing relative to the U.S.
Yeah.
I think it's probably less, but I'm talking off the top of my head there.
And that's the challenge, and it's funny because I've been given grief in the past because I don't usually talk about Chinese economic data on this show, and that's simply because I don't know what to trust coming out of China. That said, something like Evergrande, people are asking, well, what sort of companies own their debt? I don't know. I don't think you'll ever really know until some of those companies start to get hit or they disclose on their balance sheet that we have Evergrande's debt.
And that's where you're going to see it, exactly. That's where it's going to start appearing. And
I think a lot of companies don't want to admit that right now. So I think you're getting some shady stuff probably happening as quick as possible to protect themselves against that potential default. And for my portfolio, hey, let Evergrande default. Let's all see how this impacts the markets, because I assure you it will hit the U.S. There are a lot of financial firms that have debt, not just of China, not Evergrande, but of Chinese companies. Remember, this is a domino effect. If all of a sudden Evergrande goes under, you have all this unsecured debt that's not going to get fixed or filled. You have companies will be taking defaults on those loans. You have the average consumer in China will stop spending because all of a sudden their money's disappeared. They'll start writing. It creates this chain event, and we do a lot of business with China, which is one of the largest trading partners. So it'll be good. It'll be exciting, that's for sure. Only time will tell.
I do need to, if I could, because we're hitting a range of topics, I do want to come back to Washington just for one little minute, because there was one other thing I wanted to mention before we got off that topic, and that is the fact that on on October 15th, we run into that situation of another potential default of U.S. Treasuries. So on top of everything else going on, we've got the potential for U.S. Treasuries, again, that debt ceiling issue. Janet Yellen is out there scraping money from other portfolios, but we're going to run out of money by October 15th, and that's an interest payment date for Treasuries.
Yeah, so we have to make a decision on the debt ceiling by October 1st. We'll run out of money on the 15th. We have infrastructure bill on the 27th. So, guys, the next week's going to start to get really exciting for our markets. Bring on the volatility. I'm looking forward to it.
And this is all self-imposed. This is what drives me crazy. We know they're going to raise the debt ceiling.
Of course.
I find it I shouldn't say that. We don't know anything. My apologies. A little too cavalier.
That's all right.
I would be surprised that even in this political climate, we would let the U.S. government go into default. So I would be surprised if that happens, which means this is all just self-imposed mayhem.
Yeah, I agree.
It's idiocy.
And it's timely that it coincides with the voting on the infrastructure bill, because again, you're going to have one party saying, well, we'll vote for this if you guys do this, and we'll do this. Just do what's best for our damn country, will you? Okay. So you did a companion session tomorrow for your bond signature series. Let's talk about that for a little bit. How's that going? I haven't had a chance to step in there, man. I've been so darn busy.
Oh yeah, no, that's been fun. With the pandemic, what we did is, having worked with OTA for a couple of years and providing some educational resources, I was invited to put together one of the signature series that the firm rolled out. And so we've got a 3-day signature series on bonds, interest rates, the U.S. economy, all the stuff that I love talking to you about. So part of the commitment from that is once you take the class, then I connect with those students on a once-a-week basis. So it's a good way to keep people abreast as to what's going on. So we've got another signature series coming up in the end of October. So we offer the showcases, which is where we kind of promote some of the content. And I got to tell you, I'm starting to become a real rallying flag. Once again, we've had this conversation about people should be looking at tips in this market.
Yes.
With the rising inflation, it's not a question, is inflation rising? It's rising.
Yep.
And, tips give you an opportunity to turn that into some positive. And I did some homework again for the XLT class I just did on that topic. And you look at the tips ETFs last year, as inflation started rearing its ugly head, they did very well. Government portfolio, I was looking at the 10-year tips ETF. 1 year return is 7.25% for a U.S. Treasury portfolio.
Very nice.
That's worth looking at. So I'm starting to focus this month on tips. That's the moral of the story. So for the signature showcases, I'll be including that. I've got an October XLT coming up on the 20th. I'll focus on that. But I really think we can turn a negative into a positive, and that being inflation.
Nice. Yeah, there's a lot of different tip ETFs out there, guys, you can be looking at. For those that don't know, these are Treasury inflation protected securities. That's what a TIPS is. There's your trivia question for the day, which basically have a floating yield rate. And they're going to adjust as rates either move up or down. And in a market environment where you have rates dropping like we had for the last decade, you probably don't want to be buying tips. They're out of favor. But now in a market environment where the writing seems to be pretty clear that we're going to have a rising rate environment, it actually there could be a very good investment because they will be raising the yields on those tips as rates start to rise. So pretty cool.
And specifically, just to elaborate just one brief bit, when we say rates going up, specifically the tips are tied to the CPI rate we've been talking about.
Right.
So that is what the rate of return is based on. So if CPI continues to go up as it is, that means the rate of return on your bonds is going up, or your bond fund if you're using the ETF. So a real interesting product in this environment.
Yeah, it's interesting as you talk about tying it to CPI, guys, which is Consumer Price Index. Remember, we had our PPI number last month was actually really bad, and all of a sudden CPI came out not so bad. But Powell did, in fact, change his talk track. I don't know if you caught this one either. He had been saying transient inflation. That's disappeared. Then it was moderate inflation, and I forgot the term he used yesterday, but it was like substantial. Like, you basically say, okay, holy crap, we're out of control here on this one. It's way harder than we expected. So I can't wait to the next meeting to see what his stance is on inflation again. He'd be like colossal or gigantic or something.
I love the fact that you are, forgive me for saying it, I'm one myself, that you are such an eco-nerd that you can actually trace the history of the adjectives that the Fed chairman has used over the last 3 meetings to discuss inflation.
Yeah.
You know the actual adjectives that he's using.
Well, it's funny because, and the only reason is he's been hanging his hat on this. He's been saying inflation inflation is this, right? And we're targeting 2 to 2.5%. And then it was like, oh, okay, we're at 3. Well, it's transient. Oh, we're at 4. Well, it's transient. Oh, it's at 5. Oh, well, it's moderate. Now it's at 5.5. Oh, it's moderate. It's an 8. Oh, well, shoot.
I'm with you 100%. I don't understand the use of the word transient. Again, my fear is stagflation. I think we got inflation really, personal opinion. Inflation is really going to start, as it has started, rearing its ugly head here.
I'm with you, and it goes back to my early economics class days, and I remember my professor specifically talking about money supply, and one of the main reasons we get inflation spikes is an increase in money supply, and looking at how I use this in one of my presentations, but from 1950 to 2020 we increased money supply M1 from 1.5 trillion to 4 trillion. Which, fine, right? And that makes sense. We got economic growth. We need money supply increase. But that's slow and steady for 70 years. And then all of a sudden, in a period of 18 months, we've increased it by over $14 trillion. Like, yeah, that's exactly. That's not good.
No, that's not good. Exactly. And I don't want to scare people, but maybe I do. But I want to put it into perspective because both at OTA and within my other practice, my business, I talk to so many people who are new coming into the industry, and they just don't have the history. I just got to point out for one moment, the reason stagflation keeps me up at night is I came into the market in 1979 when we had stagflation. And at 1979, a 30-year Treasury bond was yielding 14%. The U.S. government had to pay 14% to borrow money for 30 years. Inflation here at the U.S. was running at 21%. 30-year mortgages were 18%. I mean, that's the environment that some of us with not so much hair still remember. And that's why the stagflation is such a fearful proposal. Sure. Because we know what it's like.
Yeah, absolutely. So for the tip, people are asking which tip is he talking about. Well, there's one that's called TIP. I'll just bring it up here for you. There's TIP, which is the iShares Tips Bond ETF. That's probably the most liquid of the bunch. You can look at, I think SCHP, if I'm not mistaken, is another one. Yeah, this is the Schwab U.S. tips, and then you have TIP or STIP, which is a 0 to 5 year tip, so it's going to be shorter term. But those are kind of the 3 main ones. Some of them become very illiquid, guys. So you if you're looking at those, be careful. Make sure you check the liquidity because again, when something has low liquidity, the spreads get very, very wide on those tips.
And the difference you should look at between those for your audience is in terms of the assets, they all own government-backed tips. So there's no difference in credit quality. The difference in them will be the different maturities. So I know the iShares, the TIPS, has a duration of 8 years. It's basically 10-year TIPS. I think the Schwab one has 5-year TIPS. So when you're investigating them, take a look at the maturities. That's where you'll see difference amongst the different products there.
Right. All right, I got 2 last-minute questions. I guess there's tons of questions coming in. Margaret wants to know, is Bill Gross still the bond king? Who's the bond king? Yeah, his mind. Who would you say, sir? If you who's somebody you look up to? Go, man, that's the bond king. I mean, I look up at you. You're my bond king.
No, thank you. No, I have great, thank you. That's very kind of you, but no. I do have great respect for Bill because he's always had the courage of his convictions. When he was looking at high yield paper when the market wouldn't, he's been willing to be a maverick, and I respect that. So yeah, I do have great respect for him. I think from an economic point of view, though, because I consider bonds and economy go together, is Eyal, oh God, I just had a mental lapse. President of Cambridge University now.
Mohammed Al-Arian?
Mohammed Al-Arian.
Yeah.
He goes back to the PIMCO days also with Bill Gross. I have great respect for the two of them together. One is a portfolio manager, the other is an economist.
Yeah, Mohammed Al-Arian's one that he's my E.F. Hutton. When he talks, I listen, and it's funny.
There you go.
I have these ideas in my head about different market things, and all of a sudden he comes out and he talks. I'm like, yeah, you nailed what I was thinking. I love it.
Yeah, no, I feel the same way. I stopped to listen to him.
You follow silver or dollar? We have questions on those. Are those things that you follow in your day to day?
I really don't.
Okay, no problem.
I'd like to. I'm a bond and interest rate guy.
No worries. All right, Bill. Well, hey, thanks. I appreciate you coming on. I apologize for the little mess up yesterday. It happened.
Oh, no, my fault. My schedule issues. I apologize to you and the audience. That was totally on me. Don't take the hit on that.
No, I'll take the hit. Anytime, you're always welcome on here. I love hearing from you and getting your perspectives on bond markets. So, guys, if you're interested, Bill teaches a signature series. What's it called? It's the Bond
Aid.
Bond Aid, yes.
We were going with Bond Age, but that didn't go over.
No, that whole different group in there. It's like you're
Right.
getting whips for presents and stuff. It's kind of awkward.
So we defaulted to Bond Aid.
Like that. Cool. All right. Well, hey, Bill, thank you so much. I appreciate your time. Take care, my friend. I'll see you next month.
Always a pleasure. Thank you, guys.
Right,
Be well. Care. Safe trading. Bye now.
Guys, that was Bill Addiss of Bond Aid, his signature series for Online Trading Academy. I would encourage you guys to check that one out. I've been blessed to have worked with Bill for the past, it's been 5 or 6, maybe even longer than that, years now. Just one of those great guys out there, always willing to share his information. And when you look at someone's background and history, to me, that really is important to see what someone's story is. How did they get to be an expert in something? And pretty much his entire career has been bonds, doing bond, going to the bond auction windows for big firms, and E.F. Hutton, and he teaches for the Federal Reserve, which is crazy. He teaches bond classes for all these major banks and financial firms. Love it. So I'm glad I could have him on. If you are interested, I would encourage you to check out his signature series at Online Trading Academy. That's called Bond Aid. All right, I took all these graphics. I took a whole bunch of pictures, but I didn't bring anything up for tomorrow. So I will bring this piece up and we can see. So here is what I've got for tomorrow. Now, remember, we had Lennar and we had KB Homes report earnings. Kind of mixed results. Didn't look to be that stellar of numbers. So we have new home sales reporting tomorrow, and you can see down there at the bottom, they're expected to actually do rather well. Well, the question for me is, will they really do that well? Given the earnings numbers that came out for KB Homes and Lennar, I don't know. I'm not overly confident that those numbers are going to reach their lofty goals, even though interest rates have been dropping. Now, I'll show you the charts of, here's Lennar. It hasn't been the worst week. It's been doing okay, still holding. And then here's KB Homes. And if I'm not mistaken, I think Toll Brothers comes out soon too. They all seem to kind of come out together. What's noteworthy for me about KB Homes today, you see the volume here was significantly higher than normal on this kind of shooting star formation, which is a pretty bearish sign for KB Homes. So keep an eye on that one for maybe some downside movement tomorrow. That might coincide perfectly with some bad numbers on those new home sales. Earning wise, you don't really have anything significant tomorrow. You do have, for today, there were some interesting numbers. You had Costco. Pretty much everybody beat earnings today. It was beats across the board except Rite Aid. They beat and took a 6% haircut today on their forecast. So you had Accenture, Darden Restaurants, Nike, and Costco reported earnings today and all did very well. So let's see, I got a question coming. Is silver even worth it? Well, regardless of what happens with CL or SLV with the printing, I guess you got to look at it from a technical perspective. I am I'm long silver with a stop loss down below 2042. And right now it does not look good. It looks like we are in a pretty decent downtrend starting in mid-May, right? You got those lower highs, lower lows. I'm one of those guys who is positive on the overall macro picture for metals. I think that if we do start to get inflation and ultimately, as Big Eb says, potentially stagflation, I think that that bodes well for commodities. And I'm just kind of surprised that we've had this big sell-off in silver. So there's SLV. Here's GLD, so we can kind of see gold's not looking that great either, right? Coming back down towards these demand zones we saw last month in mid-July. So, I personally think long-term hold, yes, silver's great. I don't really... I'm not feeling very confident about being long in it right now. What else do I have here? And you got some put buying. Will oil hit $150 a barrel? No, that's easy. That's easy. Yes, oil will hit $150 per barrel. You can write it down, put it on your calendar. I said oil will hit $150 per barrel. Now, I didn't say which decade or millennium it's going to happen in. Aha, there's a trick, because obviously with inflation at some point in time, oil will be $150. It's just supply and demand, right? So the question is, when will it be $150? Well, it's not like crypto, right? Crypto can have a 2x kind of just in one day. Crude oil is going to be a little bit harder for it to move that quickly. It is still showing strength, right? Remember, I was still in that bearish camp until we get out of this blue box, but we popped right back up into that supply zone that I drew out last week or a couple weeks ago, where you're still in the blue box, but it's getting stronger, right? I thought we'd see more sell-off. Didn't happen. Luckily, I'm not short crude oil. Actually have some USO, which is a small position, but I've had that in account for a while. But coming right in this area of supply. So might be an interesting play for tomorrow. Just kind of watch and see how it reacts as it enters this zone tonight when the futures markets get back up and running. So, yeah, could it hit 150? Yes, absolutely. But if you look at the monthly here and zoom way out, I'll put a line at your 150 mark. And it's funny because it's not even like it's uncharted territory. 150, we pretty much there. From now, I think your biggest challenge isn't, hey, well, let's get to 150. It's really saying there's some levels on this chart that it's got to get through. It's got to get through this call it 106 mark. That's going to be a real strong one. But after we break above this 76.82 on crude oil, I could start looking at the dailies for some supply zones. But on the monthly, there's really nothing big to stop this. Of course, I'll want to look at the smaller time frames when we start to get there. Walter says, bet $50 it's before 2030. 2030? Yeah, I would agree with you. With it saying in the next 9 years that crude oil will get to 150, yeah. I'm with you. I can't take that bet because I think you're right. I think it'll be 150 by 2030. Now, again, this is an interesting period of time because we have so many companies and countries who are saying they're going to be going all electric by 2030. So that could seriously have a negative impact on crude oil prices. But I think we're still a couple years away from having a full fleet of electric vehicles around the world that everyone can buy into. I still think we're going to have natural resource shortages and things like lithium and other materials used for the batteries and some of the components for these vehicles. But that's a story for another day. Big Eb says, I think tomorrow will be a weak market in light of the uncertainty flying around, especially after today's jump. I do as well. I'm actually be getting up early tomorrow so I can trade the open because I think if I have to put a 50-50 bet on it, I'm saying downside market tomorrow. And actually, I think it'll probably be a fairly decent downside movement because we have so many uncertain events happening. So I really think you'll see some downside movement on tomorrow's trading. Do we get back to the lows we saw earlier this week? Probably not. I don't think it'll be a panic sell. Let me go to a daily over here so you guys can see that. I don't think you'll have a panic sell, but I think a lot of people are going to go into the weekend saying, you know what? I don't want to have big positions, right? We had this real big drop and then all of a sudden a sharp rally. I think you'll probably see this drift lower and lower and lower. Okay. All right. I'm being beeped, as you guys can probably hear. I've got to get going. Chowski, you always ask questions at the last second, Chowski. Ask me earlier, man. LPI. Ooh, Lord, that looks beautiful. Laredo Petroleum. Looks absolutely gorgeous. Okay, so this is very similar to what I had with my purchase on Solana, right? I jumped out of Solana because it went parabolic and went too far too fast. Well, you're looking at a 100% gain in Laredo Petroleum starting on August 20th to where we are today. So you're looking at just a month. 1 month, this thing's up 100%. That is pretty crazy gains. If I was in it, I would probably be getting out of it setting some trailing stops and letting it go. If I was looking to buy, I would be waiting for a pullback, probably down around that 67 mark. But man, what a gorgeous chart. I hope you're in that, Chowski. I hope that you're in that one. You're here for the whole show. Damn you. Wasn't today just a low volume test of supply? Well, I mean, was it low volume? I mean, it's still, especially in the futures contracts, you can see it was above average volume, right, for these futures products, but lower. Yeah, I don't know. I can't put my finger on it. I thought yesterday's, the day before yesterday's action was real weak. I expected there to be a bigger bounce, and all of a sudden, boom, we had 2 pretty positive days to the upside. So, what the heck do I know? Vet visit was good. Just a big allergy thing for my lovely German Shepherd. All right, I've got to get going. Walter says, Rivian IPO, I'm a fan. I love the Rivian truck mechanically. I just cannot understand how they put those headlights on that truck. I don't know if you guys have seen it, but it's like, really? Rivian, I'll bring it up here for you. Rivian headlights. I just like, what? It's got to be one of the dumbest looking front ends. It looks like a pig snout. Let's see if I can bring this picture. There you go. I'll bring this over here for you guys. You can see it there. This is the front end of the Rivian. Tell me what you guys think of that. Does that look cool, or it looks like a pig snout, Warner Brothers happy face? I don't know. I don't see why that's so cool. I've actually seen them. Yes, I did buy back into Sol. Big Ab, I'm sorry. I talk about a lot of my crypto trades in the CIL, not necessarily here anymore. I'm trying to get, but I've got in at 117.50. 117.51 is my entry price on Sol. So, not to one up you there. I beat you by 49 cents, Big Ab. But yeah, you notice that was a great demand zone on Sol. I'll show you guys. This was beautiful. But yeah, those headlights on this thing, I don't know. It just looks weird to me. It looks like a pig snout. They're growing on me, not the headlights, but I love this light bar. The light bar is awesome. I may actually try to pick one up. I like the Rivian truck, but I want the Toyota Tundra just came out with their model, and I want a full-size truck. So here is, I'll show you this one. I'm just going to show you the Solana because I thought it was just beautiful the way that this thing hit. There's my level. You guys see this little yellow line? And I didn't just draw that after the fact, okay? That was there, and that was part of my buying criteria. And if it's funny, you look at the hourly. I'm going to take the volume off this chart. Boom. Look at that tail. That tail ripped down, hit me, and then ripped right back out. So who says supply and demand doesn't work? I love it. Yes, I'm in Solana. I didn't buy a lot. I kind of wanted to buy more, but I just bought $5,000 worth, which was nice because it went from $5,000 to $6,500 in like 2 days, which I'll take that rate of return any day. Is that a bump or is it sticking out its tongue? It does look like it's sticking its tongue out at you. All right, guys, that's going to do it. I got to run. Too many things to do. Thank you so much. I hope you enjoyed Bill Addiss. Tomorrow will be a whiskey type of day. It's been a great week for me. Trading's been awesome. Hope you guys have a great day. Be careful out there. I do think you'll see downside movement just because, again, so much uncertainty happening first part of next week, plus the China issue. Yeah, better safe than sorry, or protect yourself with options if you can, just in case the doo-doo hits the fan. All right, that's going to do it for me, everybody. Again, if you have comments, questions, feedback, feel free to send those on in at TraderMerlin@gmail.com. That's the easiest way to get in touch with me. You can also, put comments down below the video if you are new and made it. If you're new, hit that subscribe button, hit the thumbs up, and thanks, everybody. I will see you mañana. I'm trying to figure out I got a new bottle of whiskey. Maybe I'll crack the new one tomorrow. I'll tell you what that is tomorrow. Take care, everybody.